Just before the crash in 2008, so also now, China's economy is slowing and its annual growth rate is 6.8%, and that is the weakest rate of expansion in 25 years. Also, one of the big driving forces behind the panic in the markets is the collapse of the price of oil. This week, the first time since December 2003, oil has been traded under $30 a barrel. Dallas Fed president said that the low prices for oil will be there for a long time. Morgan Stanley said that it may fall to $20 a barrel if China's currency continues its plunge against the US dollar. And I even read an article on CNN that the price of oil may even be at $10 a barrel. Now, whether it will fall or whether it will, rise up and it will be at the price of 40, 50, or even 60, that's not the thing here. The thing is that it has so dramatically fallen that many companies and many people in the oil sector and in the gas sector are basically, they cannot keep up with this price. And the other reason why this is so important is because if you ask the banks about the price of oil, they say this is life and death. On CNN, we read that Wells Fargo is sitting on more than $17 billion in loans to the oil and gas sector. The bank is setting aside $1.2 billion in reserves to cover losses because of the continued deterioration within the energy sector. JP Morgan Chase is setting aside an extra $124 million to cover potential losses in its oil and gas loans. It warned that figure could rise to $750 million if oil prices unexpectedly stay at their current $30 level for the next 18 months. Even Citigroup built up loan loss reserves in the energy space by $300 million. Friends, these are not small money, I'm telling you that. The bank said the move reflects its view that oil prices are likely to remain low for a longer period of time. So whatever will happen to the banks when it comes to the problem with the price of oil, that is going to be interesting. And are we going to bail out the banks soon? I'm going to talk about it soon. Also, you take a look at commodity prices, and they are the lowest since 16 years. And so mining companies like Anglo American or commodity trading firms like Glencore and Trafigura are crashing. When you take a look at junk bonds, we see what happened in 2008, and they are crashing right now. You take a look at the comparison, and some people are saying that there is a comparison to be made with the subprime crisis. Now, if you think that this junk bond crisis was only something for 2015, there are many people who are saying that junk bonds could face a very, very ugly situation this year in 2016. You take a look at the emerging markets, you see the same thing. But not only that, things are being shipped across the US by rail. It has dropped dramatically. The drop has been so severe that these enormous drops only happen when one is either going into a recession or when you are already in a recession. And we read that all such drops in rail carloads preceded or were accompanied by an economic slowdown. Obviously, we have entered an economic slowdown. You take a look at another index, Baltic Dry Index, which is, according to Wikipedia, an economic indicator issued daily by the London-based Baltic Exchange. The index provides an assessment of the price of moving the major raw materials by sea. And this is one of the key indicators that experts look at when they are trying to determine where the global economy is headed. And so taking into account with Baltic Dry Index, we just see one more evidence that we have entered a global deflationary crisis. But there is one more, perhaps a biggest and the most important problem of all, that also shows us where we are headed, and that is the derivative bubble. You perhaps remember the banks that were too big to fail in 2008? Now there are 5 US banks that are considered too big to fail, and each of them have exposures to derivative contracts of $30 trillion. Yes, you heard me. $30 trillion. Wikipedia says this about a derivative that is basically a security with a price that is dependent upon or derived from one or more underlying assets. And the most common underlying asset includes stocks, bonds, commodities, currencies, interest rates, and market indexes. In 2007, banks were exposed to derivatives of $700 trillion, and we had a huge crash. Now it's $1.5 quadrillion. If these are numbers that are not making you afraid, I don't know what does or what should. Just as in 2008, derivatives played a crucial role when the economy collapsed, this derivative bubble is twice as much now as it was 8 years ago. This bubble is comparable to the black holes of astrophysics, those artifacts of gravity collapse which will irresistibly suck in all matter that comes near them. This compared to world GDP of a mere $55 trillion, itself a figure which is inflated by financial speculation. Warren Buffett calls derivatives weapons of mass destruction, financially of course, and time bombs. So when the derivative bubble finally implodes, where do you think that we are going to get trillions of trillions, trillions upon trillions dollars that will be needed to fix things this time? We are simply running out of time. We are sitting on a bomb, and while the stock market may go up tomorrow or next day or the next week, this bubble plus the many other bubbles which we have spoken of in this clip, these bubbles are hanging upon us and they are going to implode soon, and there won't be enough money on the entire planet to fix it.